Hey guys, what's going on? Jeb here, and in today's video, we're going to be doing a little bit of technical analysis on Bitcoin, the cryptocurrency markets, and the US stock markets, because none of these markets are looking particularly healthy today. On the Bitcoin front, we're going to be zooming in here to the hourly chart and talking about this little recent pullback that we've seen in Bitcoin. Bitcoin hasn't had a major pullback in the last couple of days, but it has had something about an 8 to 10% retracement here in Bitcoin below $4,000 once again after its recent high of around $4,150. We're going to be discussing this in Bitcoin because there's definitely an argument to be made that Bitcoin is going to continue up from here towards price targets around $5,000, but I'm not so sure about that. We'll be talking about this little formation that Bitcoin is entering later on in the video, but we're also in today's video going to be discussing the S&P 500 and the rest of the US stock markets because something very, very important and rather concerning is happening on the S&P 500 and on many other stock markets in the United States. The first thing that I want to point out here is that the S&P 500, one of the most important indexes on the US stock market, this index is worth trillions of dollars, very, very important market, is down by about 18%. And you guys know we work in cryptocurrency markets here, but in stock markets, generally a market is considered to have entered a bear market after you've seen about an 18 to 20% reduction from its recent high. That is not a good thing because if we see the S&P 500 along with the rest of the US stock markets enter a bear market in accordance with many of the fundamentals such as Federal Reserve interest rates that we're going to be discussing in today's video, we could be heading straight into a recession, which would have not only implications on the Bitcoin market, but also implications on literally every single other thing that we use in our day-to-day life, such as the price of consumer goods. We're going to be discussing all of that and more in today's video. Kind of a dreary video, but definitely something that we're going to want to be aware of so that we can prepare ourselves for what may be a coming financial crisis akin to what we saw in 2006 and 2008. Anyway, guys, that's basically what we're going to be talking about in today's video. So if you enjoyed today's video, definitely consider dropping a like and hitting that subscribe button. Also, smash that notification bell so you'll be updated whenever a new video comes out. But let's go ahead and get right into it. Bitcoin is currently trading below $4,000, around $3,850. We're going to keep doing the technical analysis in here. There's not a ton that I want to talk about on Bitcoin, but we do have some things to talk about in regards to the direction of Bitcoin here over the next couple of days. But for right now, Bitcoin is trading below $4,000. Let's go ahead and do the crypto market recap and we'll jump into it. As we can see across all exchanges, Bitcoin is currently trading just around $3,900, down 4% on the day. We're going to kind of blaze through this because I really want to get to the stock markets today. I'm not even going to try to pronounce that, and DEX are all up over 10%. Linky being up 66%, so good for them. I don't know how long that's going to last, but the point here is that we do see a little bit of green, but not a whole lot. Overall, the cryptocurrency markets are very red with 3 double-digit losers: Aion, Bitcoin Diamond, and Bitcoin SV. A couple of Bitcoins down there. We have about like 10 Bitcoins now, and only one of them that's real. Anyway, Bitcoin has a daily volume of around $6 billion, and the total cryptocurrency markets have a volume of around $18 billion. That's all we're really going to be doing on CoinMarketCap today, because I want to get to Bitcoin and the stock markets because we do have a lot to talk about. Anyway, the thing that I was hinting at earlier when I circled this and talked about this formation right here was the fact that Bitcoin has seen 3 little pumps. We've seen baby pump, we've seen mama pump, and we've seen daddy pump, and now we've seen I don't know, grandma pump come over here and just crash everything. And I don't know where I'm going with this analogy. My point is that Bitcoin saw 3 little market cycles right here. We saw 1 pump, 2 pump, 3 pump, and as I mentioned in yesterday's video, you guys can go back and watch that video if you would like to get more of my opinion on this little rally that we've seen here in Bitcoin. What a lot of times happens with markets is that you'll see them work in cycles of 3. And we've seen 3 little pumps here. We've seen 1, 2, and 3. We saw 1, 2, and 3 up here. And what it seems like right now is that Bitcoin has tested and actually gotten resistance at around $4,150 and started a little bit of a retracement. I tried to say retraction and retracement at the same time, and I got retracement. I didn't know that was a word, but it now is. That's part of Jeppy's, the new language I came up with. Anyway, one of the reasons, in my opinion, that Bitcoin is starting to kind of stumble here on this little rally that it saw is that Bitcoin's already seen a 50% retracement in price action. The bears have been very strong. And of course, that bearish sentiment is still here in a major way, not only because of the 2018 bear market in Bitcoin, but also because of what we're going to be discussing in the global stock markets here in a little while. Overall, the sentiment in not only the Bitcoin markets, but in every market is bearish. And that does have something to do with Bitcoin because we don't only want to look at technicals, we also want to look at fundamentals, and that does kind of have something to do with fundamentals. So it does seem that Bitcoin is having a little bit of trouble getting up here. One thing we also want to talk about is this pattern that Bitcoin has entered, which looks strikingly like a head and shoulders pattern to me. We see a shoulder, a head, and perhaps a little shoulder. Maybe that will grow up a little bit and we'll get a bigger shoulder over here in the next couple of hours. But for right now, what it seems like Bitcoin is entering is not an inverse head and shoulders pattern, a normal head and shoulders pattern with kind of an ascending neckline right here, which would indicate that that neckline is going to be broken and Bitcoin is going to go lower if this does play out like that. And I think that's probably what's going to happen. I think Bitcoin's probably going to break this uptrend of support and probably start moving down here towards price targets of around $3,500 to $3,700, because Bitcoin, a lot of this has to do with fundamentals and a lot of this has to do with the strength of the bulls and the bears. That's something we have a video on in the course, link in the description, with a 20% off discount code because Christmas is coming up. But I really do think that Bitcoin is going to be doing very well here. We have seen a double top form up here. That's not a very bullish sign. We do see that we had a little bit of support right here, and we've actually tried to get above it and actually broken below it. As you can see, Bitcoin had some levels right there, and right there that defined a level of support / resistance. We tried to get through it a couple of hours ago, and we weren't able. Overall, Bitcoin does seem to be a little bit more bearish over the next couple of days. Now, I really do think that this little rally that Bitcoin's currently in definitely has some potential to keep on going, but for the next couple of days, I don't think it's going to continue. Bitcoin's probably going to trade sideways or slightly to the downside. Anyway, with that out of the way, let's go ahead and jump on to the main point of today's video, which is the U.S. stock markets. And this is depressing, guys, because the U.S. stock markets have been on a bull run since late 2009, since the Great Recession ended. And as you can see, they've been doing very, very well. The S&P 500 is up something like 323%, I think it was, from its bottom down here in early 2009, about 340% with this recent all-time high, when the S&P 500 went up to around 290 points, and we pulled all the way back down to 240 recently. And as we can see, if we bring out our measuring tool, that's down by about 18.5%. Now, some people will say that a bear market starts when you're 16% retraced from the recent high. Some people will say that it happens when you're 18%. Most people will say it happens when you're 20% retraced. But the point is, the global stock markets, the S&P 500, which is worth, if I'm not mistaken, over $20 trillion, are not doing very well. As we can see, and I'm tying this back into some fundamentals and into Bitcoin here in a little bit, but I want to set the stage for how bad this is. We haven't seen a major sell-off in the S&P 500 like this since the 2008 financial crisis over here, when Bitcoin started, when the S&P 500 started retracing quite a bit. As we can see right over here, after the S&P 500 came down here to the negative 20% level right down here, it set that as a level of support down here at negative 20%, and then once we broke that market structure, there was a blood fall, and the S&P 500 lost a lot of valuation. Is that the kind of thing that we're going to see come up? Potentially. But my point is here, is that the S&P 500 is not looking very good. Let's go ahead and look at some other stocks to get an idea of what the rest of the markets are doing. Amazon, for example, is not doing very well either. As we can see, Amazon has been on a major bull run pretty much since the inception of the company back over there in the late 90s. But we see over the last couple of months, Amazon has had one of the biggest sell-offs that it has ever seen, a 33% sell-off. Amazon stock is well and truly in a bear market. If we look at Apple, we're going to see the exact same thing. Apple is well and truly in a bear market. We can see that Apple is down 35% from all-time high. We can go through companies for days. I can go to Google and I can show you them. Google is not doing very well. Google is faring a little bit better than the rest of the markets, but it's down by about 23%. If we go back to the S&P 500 and we start looking at technicals, then we do potentially have a saving grace here, because individual stocks can be in bear markets, but what is really important are these major indices like the S&P 500, like the Dow Jones Industrial Average, like the Russell 3000, for example. These are very, very important indexes. And while the fundamentals are more important, in my opinion, and we're going to talk about some fundamentals with the global stock markets in a little bit, I also want to talk about some technicals here. And one thing that I do see show up on the S&P 500 weekly chart, which is very, very promising, and I hope this does come to fruition and this does actually happen, it would be the actual 200 weekly simple moving average. As we can see right here, this moving average right here is the 200 weekly simple moving average. The S&P 500 has twice in the last decade gotten support here, right down there, and right down there. It's a very important moving average, and it does look like we're going to potentially be testing that as a level of support over the next couple of days and on into the next couple of weeks. And that's a very interesting level where it's sitting right now, because if we take our measuring device out, what we would see is that is holding support at exactly 20% retrace from the all-time high for the S&P 500. So what is most likely going to happen, in my opinion anyway, is that the S&P 500 is going to continue to retrace down to this 200 weekly simple moving average, which is a very important moving average on stock markets. Don't get it twisted. That is a very important moving average. What I think we're going to see is that the stock markets are going to pull back down here and test this as a level of support. If we hold, then potentially a bear market and most likely a recession is averted. But if we see the S&P 500 fall below this uptrending simple moving average on the weekly chart here, that would indicate that we're going to see a very strong breakout, because we haven't seen this moving average be broken in a very long time. If it does get broken, it's probably going to be substantial, and the S&P 500 is probably going to crash. And if the S&P 500 is going to crash, the rest of the U.S. stock markets and the rest of the U.S. stocks are probably going to crash, and that will almost certainly lead into a recession. So this is a very, very important uptrending moving average on the S&P 500. Keep an eye on this. Watch out for the S&P 500 holding support there. Now, guys, there's a lot of different technicals that I can go into about the U.S. stock markets and on the S&P 500. I can show you 20 different charts about why the charts are not doing well. I can show you charts that are down 20%, 30%. I can show you something like Western Digital, I think, is down like 80% right now. Many different stock markets are not doing very well at the moment. But one of the most important things that we want to look at actually have to do with the fundamentals. Because while Bitcoin relies very heavily on technicals because the fundamentals are a lot weaker, since the Bitcoin market is a lot smaller, the global stock markets and the U.S. stock markets and financial markets are very, very, very heavily reliant on the underlying economy because of how large these markets are. You have to realize a lot of valuation in stock markets, in the S&P 500 stocks and many other stocks, are tied up in people's retirement. They're tied up in people's investment. They're tied up in people's savings. Some people try and put their savings in stocks, hoping to use a stock market as their savings account. You have a lot of people with a lot of money, and I do mean a lot of money, tied up in the U.S. stock market. So when these stock markets start going down and when the fundamentals start looking bad, people pull their money out of the stock markets, which can cause a larger bear market, which can exacerbate the already pretty bad bear market and recession that we've entered. And I'm not going to go into all the different all the different fundamentals that have to do with the stock markets and have to do with the potential for a recession, but I do want to talk about one, and that would be the Federal Reserve interest rate. This is a very, very important chart. If you guys aren't familiar with this chart, I highly recommend you guys read up on this and read up on Federal Reserve interest rates. This is a very, very important chart. In fact, a lot of people consider that the Federal Reserve interest rate is the most important interest rate on the planet simply because of the ramifications it has on the global economy. And let me go ahead and show you what we're looking at here. We're looking at a chart of the Federal Reserve interest rates since 1980, and we can see them fluctuating here over the last several decades. And we can also see these little gray boxes here represent recessions. As you can see right here, we see the 2008 and 2009 financial crisis. Right here, we see the dot-com bubble recession that followed. We see the recession in the late 80s, early 90s. We see the recessions back over here in the early 80s. And what you see with many of these different charts is that whenever these recessions happen, it happens at a time when the Federal Reserve is reducing interest rates. As you can see right here, back in the early 90s, when a recession happened, the interest rates were in general going down. Right over here, when we saw a recession happen in 2001, interest rates were in general going down. And the exact same thing happened in 2008. Now, one of the reasons that happens is because that when well, the first thing I want to preface with is that this isn't the only fundamental that has to do with recessions. Of course, many of these recessions happen for many other reasons. We're going to be getting into those in a second. Of course, the dot-com bubble didn't have everything to do with interest rates, but a lot of the times this does correlate. And one thing that we see recently in recent memory is that over the last several years, Federal interest rates have been extremely, extremely low. From around 2009 to 2015 or 16, interest rates were down here around 0.15%, as opposed to where they are now, as they've been hiking and hiking and hiking over the last 3 years, up around 2.4% at the time being. And that's very interesting because what we saw is that the Federal Reserve brought these interest rates really, really low after the 2008 and 2009 financial crisis to try and bolster the economy, to try and get people to go out there and take loans and start putting money back into the market, putting liquidity back into the market, putting volume back into the market, if you will. We saw that happening a lot. We saw the Federal Reserve trying to get interest rates really low. They did get interest rates really low to try and incentivize people to go and put their money back out into the economy rather than in their bank account. And it worked. The 2008 financial crisis was averted. Well, it wasn't averted, but it came to an end anyway. The global economy didn't just collapse as if it was the end of civilization or anything. And we did see a 10-year bull market, the likes of which we haven't seen in a very long time. The S&P 500 thrived under those interest rates. But one thing that we've seen over the last couple of years is that that's coming back to bite us because we've seen these interest rates be so low. Debt has been free recently. Of course, banks have a slightly higher interest rate than the Federal Reserve does because the banks have to make their own money. They have to take their cut. But interest rates have been so very low that people have been going out and borrowing money basically for free, which is one of the reasons the real estate markets have been doing so well. It's one of the reasons that so many markets have been doing so well, and also one of the reasons that debt has risen so much. We're going to be talking about this debt calculator and this debt clock over here in a second. But that's a big problem because while we did see the 2008 and 2009 financial crisis come to an end, partially because of low interest rates, that has set the stage for an even worse financial crisis to come, because what we've seen is that debt across the board has skyrocketed. We're going to be talking about this in a second, but the point I want to make before we get into that is that the Federal Reserve has been trying to correct this. Over the last couple of years, we can see that interest rates have been climbing and climbing and climbing, and gradually we've seen some more economic stagnation. Now, of course, the economy is doing okay. The economy is doing all right, at least it is for now. In 6 months or a year, maybe not. But for the time being, we've seen a bit of economic slowdown. The real estate markets have gotten a little less bullish. We've seen overall the markets have slowed down a little bit, and that's okay because the markets were just running like a bull on a run, if you will. But the one thing that's come from these very low interest rates has been a lot of debt. If you come here to usdebtclock.org, you can see the debt. You can see a lot of different kinds of debt, but there are a few kinds that we want to talk about here. We want to talk about the personal debt, and we want to talk about the U.S. national debt, mortgage debt, loan debt, credit card debt, all those kinds of debt, and also this figure right here, which is debt per citizen. This is a very, very important figure because what this calculator calculates is that there is about $59,000 worth of debt per citizen of the United States of America. We can also look and see the U.S. national debt is up close to $22 trillion. That is over 100% of U.S. gross domestic product and around 6 years of federal tax income just to pay that off. U.S. Total personal debt's around $20 trillion. Mortgage debt's around $15 trillion. Student loan debt's up over $1.5 trillion. Credit card debt is over $1 trillion. And these aren't just numbers that don't mean anything. These are very important fundamentals when it comes to the strength of the market, because this is where everything comes and ties together. Guess what the problem is with many of these kinds of debt? Not so much for mortgage debt, because most people lock in an interest rate, but for many of these other kinds of debt, these debts work off of variable interest rates. And what does that mean? Well, for the last several years, when people were taking out these loans, they were taking out loans with very, very low interest rates, and they were taking out long loans. For example, they were using credit card debt, and they're still trying to pay it back, or they had other kinds of loans, maybe a car loan. Maybe they took out their student loans on variable interest rate loans. And over the last couple of years, since interest rates have been climbing, those loans have gotten more expensive, but the amount of debt in the market has continued to rise. And what that means is that people have more money, more of their paycheck going towards paying off debt rather than putting it in the market and stimulating the economy, which is a very bad combination when we're already looking like we're going to be entering a bear market. You see how all this ties together? You see that interest rates are climbing, so that people are having to spend more money on things that are not stimulating the economy, like going out and buying from Facebook ads, or buying the Cryptocurrency Technical Analysis Academy linked in the description, or investing in the stock market. You see a lot more people trying to pay off these loans and debts to the bank rather than being able to stimulate the global economy by putting their money into the market. And that's a very big problem, because if we see a major 2008 style bear market start in the stock market at the same time that interest rates are climbing, then what do we see? We see that the Fed has to try and drop these interest rates off a cliff like they did back over here in 2008, and the cycle repeats itself. Maybe the next bear market won't be a major economic crisis. Maybe it will only last 18 months or so like a normal recession does, but somewhere down the line, this is all going to catch up with us, and this debt that the U.S. national government has been accumulating, and that the citizens of the U.S. and many other countries indeed have been accumulating, is going to catch up with us, because you can't just default on all the debt, or you can crash the economy that way. We're looking at a very big problem coming in over the next couple of decades, and perhaps over the next couple of years, depending on how the markets turn. My point is that things are looking rough, and the economy is not looking all that great. And over the next 2 to 3, 4, 5 years, probably the next year or two, to be totally honest, we're going to see some kind of major crash in the markets, and we're probably going to see this 200 weekly simple moving average here be broken. We're probably going to see a very large bear market here in the S&P 500 and many other markets, and it's not going to be good. And your guys are going to want to be prepared for it, which is why I wanted to discuss it in today's video. Tell me in the comments section down below what you guys are doing in preparation for this. Do you guys have your money sorted away? Do you have all your money in Bitcoin, hoping that a bull market will start during the global economic crisis? What do you think is going to happen here? Of course, a lot of us are pretty young. A lot of you guys are in your 20s. I'm not gonna. You guys don't know how old I am. I'm gonna keep it that way. But my point here is that a lot of us are not old enough. A lot of you guys are not old enough to have been around during the 2008 financial crisis over here. A lot of people, especially the millennial generation and the generation younger than them, have not lived through a major financial crisis, at least while they were an adult. and we're not ready for it. A lot of people are not ready for it, so you have to be very careful in how you go about this. You want to have a lot of liquid cash on you, for example. You don't want to have a lot of your money tied up in loans. You don't want to have a lot of your money tied up in stock markets when they're doing poorly. So tell me in the comment section down below how you guys are preparing for this, and what do you guys think about this in general? Do you think some kind of major bear market and recession is coming? Do you think there's a big problem with Federal Reserve interest rates right here? Do you think there's a very big problem with the U.S. national debt, mortgage debt, student loan debt, credit card debt, personal debt, all these kinds of debt? Tell me in the comment section down below what you think is going to happen. And also tell me if you would like to see more content relating to global financial markets and to the global economy. I would love to talk about it some more because it's definitely something that I'm passionate about. Of course, we all lived through 2008, and it was not pleasant. It was not pleasant at all. Whether you were a child or whether you were an adult, it was not pleasant, and we don't want to see the same thing happen again. So I'm more than happy to continue talking about global stock markets and financial markets and the global economy if you guys would like to see that. Also, tell me what you think is going to happen here on Bitcoin. All of a sudden, our problems on Bitcoin seem very, very small in relation to the kind of thing that we're looking at here on the S&P 500 and in relation to Federal Reserve interest rates. Anyway, guys, that is going to do it for this video. Or if you are interested in joining the Cryptocurrency Technical Analysis Academy and you want to learn how to do technical analysis, I do highly recommend you check out the link in the description. We do have a sale going on until midnight of Christmas, so Santa Claus has brought you guys an early present, and that's a 20% off discount code for the Cryptocurrency Technical Analysis Academy. Christmas 2018, all caps. Put that code in, you'll get 20% off, lowering the price from $149 to $119. It's a great product that I put my heart and soul into. Guys, if you want to see what we have to offer over there, check the link in the description. I think you guys will enjoy it if you join. We've had hundreds of people join the course. I haven't had any complaints. We've had a couple of pieces of constructive criticism, of course, and I've resolved those. I try and get back to everyone. Well, I don't try and get back to everyone. I do get back to everyone who's in the course, and I'm more than happy to help you guys on a one-on-one individual basis in the course if you join. Anyway, guys, that is actually going to do it for today's video. I do want to thank each and every single one of you for watching, as always, and I will see you guys after the 2018 financial crisis. Peace.